Hey, what's up everybody? It's Saturday, March 6th. So today I want to talk about yield curve control. You may have been hearing a lot about that. Fed has to now engage in yield curve control. What does that mean? It means basically adjusting the shape or the slope of the yield curve. Now first, before we even get into that and how the Fed would affect that or how it would carry that out, understand that because the Fed is the rate setter, the monopolist rate setter, then by definition it is always controlling the shape of the yield curve. Because as I've explained in the past, the interest rate all along the term structure is nothing more than the expectation of Fed policy over that term. So in other words, the rate on a 2-year treasury is the expectation of Fed policy over 2 years. A 5-year treasury, expectation of Fed policy over 5 years, etc. 10 years, 30 years. And if the Fed said tomorrow, hey, we're going to make the zero rate permanent, or we're going to make whatever, the 25 basis point rate permanent, then the whole entire yield curve would flatten out at that rate. So that's essentially yield curve control. It's just kind of embodied in the reality that the Fed is the monopolist rate setter. But that's not what the market or market observers are talking about when they mention yield curve control, because now everybody's all bent out of shape with this steep yield curve and long-term bond yields going up. And I've explained why that's happening. That's a technical issue, all right? That's because reserves being piled onto the banking system, onto bank balance sheets right now, is actually forcing the banks to liquidate treasuries to make room for those reserves, all right? So they stay within the construct of their leverage ratio, that's regulatory, mandate, regulatory requirement. So the selling of the treasuries is pushing up longer term bond yields. But people are saying, hey, that's no good. Fed, you got to stop that. You got to figure out a way. So you got to do yield curve control. So what would they do? One example would be they could buy, the Fed has been monthly buying assets, right? They could buy longer dated securities, bring down the yield there, and allow, let's say, the short dated securities to just roll off the balance sheet, essentially, selling them out. So that would flatten out the yield curve. But you see, what's happening right now, as I've explained before, is really just a technical issue. And if you want a kind of an analogy, it's like a pig moving through the body of a python. If a python or an anaconda swallowed a big animal, it goes through, it has to be digested. So when all this, when the Treasury eventually brings its balance down in its account to the level where it wants, all this reserve dump onto bank balance sheets will be done, it will be finished. It won't any longer necessitate the sale of those treasuries. The yield curve would again reflect Fed monetary policy over that term. So it's a whole bunch of hullabaloo for nothing, basically. But hey, how many times have we seen this kind of stuff before? So many times. You remember 2 years ago, the inverted yield curve. Oh my God, the inverted yield curve, the inverted yield curve. I made videos back then saying that was a technical issue related to the debt ceiling, okay? And once they lifted the debt ceiling, what happened? You went back to a normal positive sloped yield curve. So I mean, it's all a bunch of nothing. The Fed, by definition, as the monopolist rate setter, it automatically is involved in yield curve control. So when you hear that, now you understand hopefully what it is. It's no big deal. And I'm going to leave you with that. Have a great Saturday. See you tomorrow, everybody. Bye-bye.